Imagine you're the chief financial officer of a Fortune 500 company.
Okay, stressful job right now.
Absolutely.
Yeah.
So it's a Tuesday morning, and your desk is just an absolute war zone.
Yeah, I can imagine.
I mean, the government has just mandated these sweeping budget cuts that might, indirectly impact your federal contracts.
Right.
And looming global tariffs are threatening to just entirely upend your Asian supply chain.
Which is a nightmare for margins.
Complete nightmare. And to top it all off, your CEO just sent you an email demanding a 10% reduction in all discretionary spending.
By the end of the quarter, probably.
Exactly. So your cursor is hovering over $1 million annual advisory subscription.
Okay.
Do you cancel it?
I mean, instinct says yes.
Right.
Yes.
You would think in an environment of total panic and cost cutting, the answer is an obvious yes.
For sure.
But the data we're about to look at today tells a completely counterintuitive, just a fascinating story.
It really does.
Welcome, everyone, to a very special Talk Tickers Deep Dive.
Glad to be here.
If you're joining us today, you know our mission. We bypass the carefully manicured executive summaries, we ignore the PR spin, and we go straight to the raw source material.
We want the actionable insights for your portfolio.
Exactly. So today, we are putting Gartner Inc. under the microscope, analyzing their Q4 2025 earnings call transcript.
And that CFO scenario is the perfect way to frame this, because for those of you trying to navigate an incredibly volatile, unpredictable market right now,
Which is most of us.
right, Gartner is the ultimate case study. For anyone unfamiliar, this is the premier IT research and advisory firm in the world.
The absolute gold standard.
Yeah, they're the company that executives, like the hypothetical CFO you just mentioned, literally pay to tell them how to navigate uncertainty.
They're the compass.
Exactly, they're the compass.
Yeah.
But what happens when the macroeconomic uncertainty directly hits the compass manufacturer?
That's the billion-dollar question.
Right. How resilient is an advisory firm when the entire global corporate landscape is freezing its budgets?
Exactly. And that's the journey we are taking you on today. We're going to translate the Wall Street jargon from this specific earnings call into plain, usable, everyday language.
No fluff?
None. We're going to take the headline numbers and stress test them against a macroeconomic backdrop that sounds incredibly chaotic.
Highly chaotic.
We will decode what management is actually signaling about their guidance for 2026.
Because that guidance was, well, it was interesting.
Very. And by the end of this conversation, we are going to provide a definitive, highly opinionated stance on whether this stock is a bullish compounder hiding in plain sight or a bearish value trap that you just need to avoid.
And just to be completely clear on our parameters for you listening, we're basing our entire analysis today strictly on the raw transcript of their Q4 2025 earnings call.
Right, no outside noise.
Exactly. We aren't pulling in outside punditry. We aren't looking at what analysts on financial television are guessing might happen.
No talking heads.
Just what Gartner's management explicitly stated, the financial data they formally reported to the SEC, and what those mechanics actually mean for you as an investor trying to allocate capital.
Okay, let's unpack this. We need to start by anchoring ourselves in the raw financial data.
Always the best place to start.
Because the numbers here are telling a story of massive contrast. Let's look at the top line first.
Okay.
For the fourth quarter of 2025, Gartner reported revenue of $1.8 billion.
Which is a huge number.
It is. That's up 2% on a reported basis, but, and this is big, but if you look at it on an FX neutral basis.
Meaning stripping out the currency fluctuations.
Right. If we strip out the mathematical noise of currency exchange rates fluctuating around the world, revenue was completely flat.
0% growth.
Zero. Now, for the full year of 2025, revenue came in at $6.5 billion, which is up 4% on a reported basis.
Okay, decent.
And turning to profitability, their adjusted earnings per share, or EPS, for Q4 was $3.94, bringing their full year 2025 EPS to a very robust $13.17.
Yeah, and those revenue and earnings figures are the numbers that hit the headlines, but if you want to understand the true engine of this business, we have to look past the income statement.
Right. We need to look at the cash.
Directly at the cash flow statement. Because the massive takeaway here, the absolute anchor point for any serious investor, is their cash generation and their capital allocation strategy.
It's pretty wild.
It is. For the full year of 2025, Gartner generated $1.2 billion in free cash flow.
Okay, let's pause right there and contextualize that for a moment. We throw the term free cash flow around a lot, but what does that actually mean in the context of a business like Gartner?
It's the most important metric of financial health, honestly.
Right.
Free cash flow is the actual tangible cash left over after a company has paid all of its operating expenses and all of its capital expenditures.
Like buying new servers.
Yeah, or upgrading office space, paying salaries. It's the money that management can actually put in their pocket, or in this case, return to shareholders.
Okay.
So generating $1.2 billion in pure free cash flow on $6.5 billion in total revenue is a phenomenal conversion rate.
It's massive.
To put that into perspective, for every dollar of GAAP net income they report on an accounting basis, they're generating over $1.60 in actual free cash flow.
Wow. Over $1.60.
Yeah. It's essentially a cash geyser. And the real story is what management decided to do with that $1.2 billion.
Because they didn't just sit on it?
No, they didn't. They aggressively repurchased $2 billion of their own stock over the course of the year.
I need to highlight the sheer magnitude of that number. $2 billion in stock buybacks.
Staggering.
By doing that, they retired approximately 8% of their total outstanding shares in a single 12-month period.
8%.
8% of the entire company was effectively bought up and taken off the public market.
Right, just gone.
When you own a stock, you own a slice of the company's total pie. Gartner just bought back 8% of the pie and threw it away.
Mathematically making your remaining slice that much bigger.
Exactly. That much more concentrated with earnings without you having to lift a finger or invest another dime.
And what's fascinating here is how that capital allocation pairs with their underlying operational efficiency.
Right. The return on the investment.
Yeah. When you're assessing whether a management team is competent, you look at their return on invested capital, or ROIC.
Okay.
This metric tells you how much profit a company generates for every dollar it invests back into its own operations.
And Gartner's was high.
Very. Gartner's ROIC for 2025 remained exceptionally strong at around 24%.
Okay, so if they invest $1 into hiring an analyst or building a new software tool, they're historically generating a 24-cent return on that dollar.
Precisely.
No.
And a 24% ROIC is elite territory.
Oh, absolutely.
Most companies would kill for a 10 or 12% return. So when you combine these two elements, a company that can organically generate a 24% return on the cash it deploys internally, right, while simultaneously using its excess cash flow to shrink its overall share count by 8% in a single year, you're looking at the exact mechanical definition of a financial compounder.
It's textbook.
They're running a highly lucrative asset-light advisory business, and they're using the proceeds to relentlessly condense the equity value for the remaining shareholders.
Okay, I hear you. The cash flow's a geyser, the ROIC is elite, the share count is shrinking. That all sounds like an invincible fortress.
It does.
But I'm going to push back here, and push back hard, because there is a glaring contradiction in this earnings report that we just cannot ignore.
Okay, let's hear it.
Let's look at their core underlying business model. Gartner is a subscription business.
Correct.
Executives sign annual or multi-year contracts for access to their research, their analysts, and their tools. And if you've ever analyzed a software as a service or a subscription company, you know the single most important forward-looking metric is contract value, or CV.
It is the pulse of the company.
Exactly. It's the total annualized value of all their recurring subscriptions. It tells you exactly the speed at which their recurring revenue engine is growing.
That's right.
Well, according to this transcript, Gartner's total contract value in their core insights segment grew by a very modest, completely anemic 1% year over year.
Landing at $5.2 billion.
Right, landing at $5.2 billion. Top line reported revenue is only up 2%, and contract value is practically flatlining at 1%.
Yeah, 1%.
So here's my challenge to you. If the ROIC is so incredible and the product is so essential, why has growth hit a brick wall?
It's a fair question.
I mean, for a premium advisory firm that charges premium subscription prices, a 1% growth rate doesn't sound like a compounding machine.
No, it doesn't.
It sounds like a busted growth story. How on earth is a 1% expansion in contract value not a blaring red siren for anyone holding this stock?
You have every right to be skeptical, and honestly, if you just read the headline summary on a financial terminal, that 1% figure looks terrible.
It looks awful.
But this is exactly why you have to look under the hood. You have to strip away the aggregate number and look at the actual composition of the segments.
Good.
Because the drag on that contract value is incredibly concentrated in one specific area.
Okay, let's peel the onion. Where's the drag coming from?
It is almost entirely localized within the U.S. federal government sector.
The government sector.
Yes. If you entirely strip out their public sector federal business from the equation, contract value actually grew by 4%.
So the U.S. federal government is the anchor here.
Yes. And if we drill down even further into their commercial segments, specifically their global business sales, or GBS.
Which is what exactly?
This is the division that sells advisory services not just to IT departments, but to other massive corporate functions like supply chain leaders, human resources, and legal departments.
Okay, got it.
That GBS contract value outside the federal sector grew by 6%.
Oh, wow, 6%.
And within that 6%, management specifically called out their supply chain and legal practices as leading the growth.
Interesting.
So if you're looking at the core commercial enterprise engine, the everyday Fortune 500 companies, the mid-market businesses, they're seeing high single-digit to mid-single-digit growth across virtually all company sizes.
That's a totally different story.
Exactly. The fundamental engine is absolutely humming. It's just being severely mathematically muffled by a highly specific, isolated macroeconomic shock in the public sector.
Which naturally leads us to ask, what exactly is that macroeconomic shock? Right. We see the 1% headline number. We see it jumps to 4% or 6% when you remove the government. But what is the actual on-the-ground reality driving these numbers?
Well, what's fascinating here is if we look at what management detailed on this call, it was a highly volatile, completely chaotic selling environment throughout 2025.
Yeah.
This was not a year where sales teams could just sit back and watch automatic renewals roll in.
Right. And to be completely objective here and look strictly at the mechanical business impact of the external environment, management spent significant time on the call discussing the Department of Government Efficiency, or the DOGE initiatives.
It did.
Now, stripping away any political context entirely and looking purely at the operational mechanics, these initiatives mandated massive funding shifts, structural audits, and intense, unprecedented budget scrutiny across federal agencies.
Constant audits.
And Gartner noted on the call that virtually all of their U.S. federal clients operate on one-year contracts.
And that one-year duration is the critical vulnerability here.
How so?
In the commercial enterprise world, you might sign a 3-year master services agreement, but in the federal space, procurement officers are often bound by annual budget appropriations.
Exactly. So what happens when an overarching federal efficiency mandate suddenly freezes agency spending to audit all external contracts?
Everything stops.
Right. It's not necessarily that the agency director looks at Gartner and says, this research is useless, let's cancel it.
No, not at all.
It's that the procurement officer literally does not have the authorization or the budgetary clearance to sign the renewal paperwork while the overarching audit is ongoing.
Right, their hands are tied.
Exactly. Those one-year advisory contracts are either immediately put on the chopping block to meet an arbitrary reduction quota, or at the very least, they are severely delayed into the next fiscal year.
Just pushed out.
Yep. That isolated procedural roadblock is what completely crushed that specific reporting segment.
It's a systemic freeze, not a reflection of product value. But, it's important to note that it wasn't solely the government sector facing massive headwinds in 2025. Management also clearly outlined how evolving trade policies and the looming threat of significant global tariffs created a massive wave of hesitation among their enterprise clients.
This is where we go back to the supply chain executives we mentioned earlier.
Yes, let's look at them.
Let's walk through the psychology of that. If you're the head of global supply chain for a major consumer electronics brand,
okay,
and you're trying to figure out if your raw materials imported from Asia are suddenly going to be hit with a 15 or 20% tariff, your entire financial model is thrown into chaos.
Totally upended.
You literally don't know what your margins will be next quarter.
Exactly. And what is the immediate instinctive reaction of any competent executive when faced with that level of existential uncertainty?
Freeze everything.
You freeze all discretionary spending, you halt new hiring, you delay software upgrades, and you scrutinize every single vendor contract.
Right.
You wait until you have regulatory clarity. Add to that tariff anxiety a shifting landscape for legacy tech companies who are trying to pivot into the AI space while managing their own bloated cost structures.
Which is a whole other mess.
And you end up with a corporate environment where Every single purchase, every single renewal requires an elevated level of deal approval.
Yeah.
A contract that a mid-level manager could have signed off on in 2023 now has to go all the way to the CFO's desk for justification in 2025.
The buying cycles get dramatically extended. Decisions that took 3 weeks now take 3 months.
Exactly.
Executives are effectively paralyzed by the macro environment. So the ultimate question is, how did these paralyzed executives actually behave when the Gartner contract renewal landed on their desk?
That's the key.
We established earlier that they didn't just mass cancel everything because the commercial retention rates remained strong, but they were under orders to cut costs.
Right.
So what was the mechanism? How do they reconcile needing the insights with needing to shrink the budget?
What management observed and what they detailed on the call is a very surgical approach to budget reduction. Instead of severing the relationship, clients reduce their seats.
Okay, let's explore this because this is the difference between a broken product and a cyclical headwind.
Totally.
To use an analogy, imagine a family trying to cut their household budget during a recession. They might look at their streaming services.
Right, the Netflix budget.
Exactly. If they decide a service is terrible, they completely cancel it. That's churn.
Right.
But if they look at their Netflix account, they know they still want the shows. So instead of canceling, they downgrade from the $22 a month 4K premium family plan down to the $15 standard plan.
Yeah, that makes sense.
They retain the core service, but they optimize the cost. Is that essentially what's happening at the enterprise level with Gartner?
That is a perfect analogy. An enterprise client might have a historical contract for, say, 10 individual user licenses or seats for their core IT leadership team. Over the course of the year, one of those executives retires, or perhaps the company undergoes a minor restructuring and a role is eliminated.
Sure.
In a boom economy, the CFO would just transfer that Gartner license to a new hire or keep it active for the next promotion.
Just eat the cost.
Right. But in the 2025 environment of budget freezes and intense scrutiny, the CFO looks at the contract and says, "We are under a mandate to cut 10%. We aren't going to cancel Gartner because we desperately need their cybersecurity research right now.
Right.
But we only have 9 executives in the department today. Drop the contract down to 9 seats."
Wow. Okay.
They're preserving the core relationship. They're maintaining access to the proprietary intellectual property, but they're trimming the absolute margins of the contract to appease the budget mandate.
And the mathematical data completely validates this behavior.
It does.
Despite all of this macro turbulence, the DOGE disruptions, the extended buying cycles, the tariff anxiety, Gartner's global business sales wallet retention remained at an absolutely stellar 99%.
99%.
And if you look outside the U.S. federal sector, wallet retention was actually over 100%.
Let's make sure the listener understands the gravity of that number. A wallet retention rate of over 100% means that on average, the cohort of commercial clients who were with Gartner last year actually spent more total dollars with Gartner this year.
Even with the seat reductions.
Exactly. Even after factoring in any of those seat reductions or downgrades, the upsells and price increases more than offset the trims.
Which fundamentally proves the stickiness of the product.
Absolutely.
When the external environment is chaotic, when tariffs are looming and supply chains are breaking, corporate leaders actually need validated, trusted insights more than ever.
They can't fly blind.
They can't afford to fly blind. But here's the thing. Gartner management didn't just sit back, look at their 99% retention rate, and rely on their historical prestige to weather the storm.
No, they didn't.
The most compelling, forward-looking part of this earnings call was management outlining a massive, aggressive internal transformation strategy.
Which is so important because, how does an established legacy advisory firm adapt to an era where information moves at the speed of light?
Yeah, it's tough.
Management recognized that the rate of external technological and economic change is accelerating exponentially. Relying on old methods of delivering research wasn't going to cut it anymore.
Not at all.
They had to radically and fundamentally increase their client engagement. They detailed how they are executing this transformation across 4 distinct operational dimensions, which are impact, volume, timeliness, and user experience.
Okay, let's break down the mechanics of each of those dimensions, because this isn't just corporate buzzword bingo. This is how the company is structurally future-proofing its revenue engine against AI and competition.
Yes.
First up is the concept of impact. Gartner is shifting away from generalized research and becoming laser-focused on the exact existential questions their clients are asking right now.
And in 2025, there's really only one question on every executive's mind.
Artificial intelligence.
Exactly, artificial intelligence. The mandate for every Fortune 500 leadership team is to figure out how to deploy AI before their competitors do.
While not creating a massive cybersecurity vulnerability or violating data privacy laws.
Right, which is a tightrope.
And Gartner's response wasn't just to publish a handful of high-level white papers. They completely flooded the zone.
Flooded it.
They expanded their proprietary AI coverage to include over 6,000 deep dive AI-related research documents.
6,000.
They documented over 1,000 highly specific real-world AI use cases.
Meaning they aren't just talking about theory.
Right. They're showing a logistics company exactly how a competitor is using an LLM to route shipping containers.
Actionable intelligence.
Exactly.
Yeah.
And most importantly, they conducted over 200,000 individual in-depth client advisory conversations specifically centered around AI deployment in 2025.
That level of engagement is staggering, but, it creates a massive logistical problem.
How do you mean?
Well, when you're generating 6,000 documents on a single topic, and you're trying to serve clients in 90 different countries across every conceivable industry vertical, how do you manage the volume of insights?
Right.
You can't just blindly hire 10,000 new human analysts and hope they write about the right things.
Right, which brings us to their second dimension, volume. And the mechanism they used to solve this is fascinating. They built and implemented a proprietary, newly developed neural network AI model.
Very smart move.
But they didn't build a chatbot to write the reports. They built a predictive engine to direct the human analysts.
And the data ingestion process here is wild. This neural network systematically analyzes millions of data points in real time.
What kind of data points?
It's looking at the search queries typed into the Gartner portal by clients. It's analyzing the metadata of which reports are being downloaded by which job titles.
Oh, wow.
It's scanning global news and economic indicators.
So if there is suddenly a localized disruption in semiconductor manufacturing in Taiwan, the neural network instantly detects a 400% spike in search queries from hardware supply chain executives looking for alternative sourcing.
Exactly.
The AI flags this immediately, prioritizes the topic, and essentially tells the human analysts, drop what you're doing. We need a comprehensive supply chain alternative report out immediately because demand is spiking.
Precisely. It is an operational radar system for corporate anxiety.
That is such a good way to put it.
And by using this predictive AI to direct their human capital with surgical precision, management noted they were able to grow their active, highly relevant insights library by 50% by the end of 2025 without wildly bloating their core analyst headcount.
But having the right topic doesn't matter if the report takes 3 months to publish.
No, it's useless by then.
And that brings us to the third dimension of their transformation, timeliness. The corporate world no longer operates on quarterly research cycles.
Things move too fast.
If a crisis hits, executives need answers that day.
And management recognized this critical vulnerability. They stated on the call that they've re-engineered their internal validation and publishing processes to reduce the average insight creation time by 75% for their key flagship products, including their industry standard Magic Quadrants.
A 75% reduction in production time is a massive operational leap.
Massive.
And they are pushing it even further with what they call first take insights.
Right, the first takes.
To illustrate how this works in practice, imagine a massive, unprecedented ransomware attack hits a major global cloud provider at 9:00 a.m. on a Tuesday.
Okay.
Under the old model, Gartner might have gathered data for a week, run it through peer review, and published a comprehensive post-mortem a month later.
By then, the damage is completely done.
Exactly. Under this new timeliness mandate, Gartner analysts are publishing actionable, synthesized intelligence and direct guidance on how clients should protect their specific networks on the exact same day the breach occurs.
Which completely shifts the value proposition of the subscription.
It does. It really feels like we are watching Gartner transition its very identity.
For decades, they felt somewhat like a slow-moving, highly prestigious academic publisher.
Very true.
You paid your subscription, and eventually a dense, heavily peer-reviewed journal arrived on your desk. Now, they are functionally transforming into a real-time, dynamic financial news desk.
Yeah, that's spot on.
It's almost like they're building a Bloomberg terminal for corporate strategy. They are providing these executives with immediate, synthesized, actionable intelligence that they can use to make a decision today.
Right.
And when you're delivering that kind of urgent value, it becomes incredibly easy for a CFO to justify those high subscription costs, even when they're under strict mandates to cut budgets.
I think you need it.
You don't cut the radar system when you're flying through a hurricane.
That is an excellent analogy, and it perfectly sets up the final and arguably most important dimension of their internal transformation, which is user experience.
Because you can have the most impactful, high-volume, real-time research in the world, but if an overwhelmed executive logs into the portal and can't find the answer they need, buried in a library of 6,000 documents,
Which is overwhelming.
the value drops to zero. Friction causes churn.
So how do they remove the friction?
They rolled out a proprietary tool called Ask Gartner.
Okay, Ask Gartner.
This is an AI-powered search, synthesis, and summarization engine built directly into their platform. But it's not a generic LLM.
Not just a ChatGPT wrapper.
No, it's role-based and deeply contextual.
Yeah.
When a user asks a question, the AI doesn't just search keywords. It analyzes the user's specific job title, say Chief Information Security Officer.
Sure.
It looks at their past viewership history. It looks at the mission-critical priorities associated with their profile. And then it queries Gartner's heavily vetted proprietary database to synthesize a highly specific custom answer tailored exactly to what that CSO needs to know.
It acts as an elite automated research assistant that instantly distills the 50-page report into the 3 bullet points that actually matter to that specific user.
Exactly. And the financial results of this UX improvement are undeniable.
The numbers back it up.
Management explicitly stated on the earnings call that licensed users who actively engaged with the Ask Gartner tool exhibited substantially higher renewal rates than those who relied on the traditional search interface.
Because it fundamentally proved the ROI of the platform within seconds.
Immediately.
If an executive saves 3 hours of reading because the AI summarized the exact insight they needed to prep for a board meeting, they're renewing that contract.
No questions asked.
So to summarize the operational story here, they are moving from static reference material to a daily operational necessity.
Yes.
And by structurally increasing that daily engagement through AI tools and faster publishing, they're mathematically locking in their future renewals.
Which is a perfect bridge to understanding how all of these internal changes and external macro forces project into the future.
Yes. Here's where it gets really interesting. Let's look at the guidance.
Okay, the 2026 numbers.
What is management officially telling Wall Street to expect for the full year of 2026?
Well, they laid out very specific and highly scrutinized financial projections.
Right.
For 2026, they are guiding for consolidated revenue of $6.455 billion or more.
Okay, $6.455 billion.
To translate that, it represents an expected FX-neutral growth rate of roughly 2%.
2%.
They're projecting full-year EBITDA, which is earnings before interest, taxes, depreciation, and amortization, basically a proxy for operational profitability,
Right.
to be $1.515 billion or more. And crucially, they expect free cash flow to remain incredibly strong at $1.135 billion or more.
Okay, I have to jump in here because if you're actively listening and tracking the numbers, there is a massive glaring red flag waving right in the middle of that forward-looking guidance.
They're definitely...
Is the margin step down?
Yep.
Let's look at the mechanics of profitability. In 2025, Gartner operated with an EBITDA margin of 24.8%.
Huge margins.
They kept nearly a quarter of every dollar as operating profit. But this new official guidance for 2026 assumes a baseline EBITDA margin of 23.5% or more.
A drop.
That is a highly noticeable, deliberate margin compression. Furthermore, their 2026 earnings per share is officially guided at $12.30.
$12.30.
Let's remember the number from earlier.
Right.
They just achieved $13.17 in EPS in 2025.
Right.
So to summarize the guide, revenue is projected to go up slightly by 2%, but their operating margins are shrinking and their actual earnings per share are projected to drop by nearly a full dollar.
It's bad on paper.
Why on earth would any rational investor want to buy into a business that is actively planning for margin compression and lower earnings?
Well, if we connect this to the bigger picture of how subscription sales actually work, the story behind this seemingly terrifying conservative guide becomes very clear.
Okay, explain.
And honestly, it reveals a highly strategic management team. Management is deliberately choosing to take a short-term hit to their margins in 2026 in order to aggressively re-accelerate their long-term growth curve for 2027 and beyond.
How exactly are they doing that? Where is the money going?
It's going directly into their sales force. Specifically, they're aggressively investing in what they call quota-bearing headcount, or QBH.
QBH, okay.
These are the actual business developers, the boots on the ground, who are tasked with securing new logos and upselling existing accounts.
The sales reps.
Exactly. Management stated they're planning to grow this quota-bearing headcount in the low to mid-single digits throughout 2026.
Let's walk through the financial mechanics of hiring a salesperson in a SaaS or subscription business.
Yeah.
Because the timing of cash flows is everything.
It is.
When you hire a new enterprise sales rep, you immediately bear 100% of the upfront costs.
Right away.
You pay the recruiter fee, you pay their base salary, you pay for their benefits, their software licenses, and their intensive training program.
Yep, it adds up.
All of that expense hits your income statement and drags down your EBITDA margins today.
Exactly. The cost is immediate, but the revenue is delayed.
Right.
A new enterprise sales rep selling complex million-dollar advisory packages does not walk in on day one and close deals.
Never.
It takes several quarters for them to build a pipeline, learn the product, navigate the extended corporate buying cycles we discussed earlier, and reach full sales productivity.
So management is essentially absorbing a massive wave of immediate expense in 2026 to build out an army of reps, knowing full well that those reps won't start printing revenue until late 2026 or 2027.
That's the plan.
It is a calculated structural investment in their own future capacity. They're compressing margins today to ensure double-digit growth tomorrow.
That is the exact mechanism, but that only explains the EBITDA margin drop.
Right. What about the EPS?
We still need to address that incredibly low $12.30 earnings per share projection, because this is where management is being ultra-conservative, almost to the point of absurdity.
How so? Like, what are they hiding?
Let's look at the assumptions baked into that $12.30 number. First, it assumes absolutely zero interest income on their excess cash.
Zero.
Gartner currently has $1.7 billion sitting on their balance sheet.
That's a lot of cash.
In a world where institutional yields are still generating meaningful returns, management is officially modeling as if that massive pile of cash earns absolutely zero interest throughout the entirety of 2026.
That is the definition of sandbagging a projection.
It gets even more conservative. When projecting their share count to calculate that EPS, management only modeled enough share repurchases to offset the natural dilution that occurs from employee stock compensation plans.
Wait, really?
Yeah, they did not bake in any aggressive, large-scale, accretive buybacks into that official guidance.
Wow. Let's piece this together. We just spent the first 20 minutes of this deep dive marveling at how Gartner used their free cash flow to buy back $2 billion of stock and retire 8% of the entire company in 2025. They have $1.7 billion in cash sitting idle right now. They clearly view their own stock as the best investment available.
Clearly.
But for their official public 2026 guidance, they are essentially modeling a scenario where they keep their hands entirely in their pockets and do nothing with the cash.
Exactly. It is a classic under-promise and over-deliver setup.
For sure.
There is massive immediate upside to that $12.30 EPS number if, or realistically when, they decide to deploy that cash pile either into a yield-bearing instrument or, more likely, into another massive wave of share repurchases.
And there's one final crucial piece to this 2026 puzzle that we haven't mentioned yet, the divestiture impact.
Yes.
This forward-looking guidance entirely excludes the financial contribution of their digital markets business.
Right. Gartner recently entered into a definitive agreement to sell off the digital markets segment,
which is a textbook example of addition by subtraction. When a company realizes a division isn't core to their long-term thesis, selling it off generates immediate capital. But more importantly, it frees up an immense amount of executive management bandwidth.
Bandwidth is everything.
Instead of worrying about a non-core asset, leadership can focus 100% of their operational energy and capital on supercharging that highly lucrative, highly sticky core insights engine that we just analyzed.
It streamlines the entire narrative. They're purifying the business model to focus purely on high-margin enterprise advisory.
So what does this all mean? We have reached the final stage of our analysis.
The bottom line.
We have dissected the headline numbers. We have explored the macro chaos of DOGE and tariffs. We understand the mechanics of their AI-driven internal transformation. And we have decoded the ultra-conservative nature of their margin guidance.
We covered a lot.
Now, we need to distill all of this into a clear, actionable stance on this stock.
Well, this raises an important question for you, the investor, sitting at home looking at your portfolio. Is Gartner simply a mature company that has hit a wall, a victim of government efficiency cuts in a tough macro environment that is destined for sluggish 1% growth for the foreseeable future? Or are they a remarkably resilient, fundamentally sound compounder that is actively using this period of external chaos to optimize its operations and aggressively position itself for the next massive economic expansion?
We promised a definitive, opinionated stance, and we're going to take one right now.
Let's do it.
Based on the mechanical realities of this earnings call, the underlying numbers paint a highly, highly bullish picture for long-term investors.
I agree completely.
Yes, if you only look at the surface, the top-line growth looks momentarily sluggish. A 1% contract value growth rate is never going to make exciting headlines on financial television.
It's boring.
But when you look under the hood and understand the mechanisms at play, you realize that sluggishness is almost entirely artificial. It is driven by the U.S. federal contract resets, a systemic procedural freeze that is a one-time shock to the system, not a permanent loss of demand.
And when you look past the public sector, the core commercial business is proving to be remarkably sticky.
Amazingly sticky.
Despite executives being paralyzed by tariffs and budget cuts, wallet retention stayed above 100% outside the federal sector.
Exactly. You're looking at an absolute cash-generating machine.
A beast.
They maintain a 24% return on invested capital. They are generating pure free cash flow at an astounding 161% conversion rate against their GAAP net income.
It's incredible.
They've built an incredibly defensive moat.
It's a financial fortress. So let's make this highly actionable.
Okay.
For someone who currently holds the stock in their portfolio, this is a very clear pound the table hold.
Don't sell.
The management team is doing exactly what you want a competent, shareholder-aligned management team to do during a chaotic macroeconomic environment. They are using the perceived weakness in the market to buy back their own stock on the cheap.
Which is brilliant.
Retiring 8% of the entire company in 1 year is a massive permanent transfer of intrinsic value directly to the remaining shareholders.
Right.
You simply do not sell a structurally sound company that is actively buying itself up at that massive scale.
I completely agree. And what about the other side of the coin?
Or new investors.
Yeah, for someone sitting on the sidelines, looking for a place to deploy capital and considering adding Gartner to their portfolio.
Okay.
Any short-term market dip caused by headline reading algorithms reacting to that seemingly light 2026 margin guidance, or any lingering sensationalized news stories about DOGE-related federal headwinds, represents a fantastic potential buying opportunity.
A huge opportunity.
Management explicitly stated on the call that they expect contract value growth to organically accelerate as 2026 unfolds.
Yes, they did.
Once they finally lap those artificial federal headwinds, and once their massive investments in quota-bearing headcount start yielding productive sales cycles, the numbers will inflect upward.
And that inflection will be supercharged by their internal AI transformations.
Absolutely.
As the speed of their insight generation increases, and as the Ask Gartner tool proves its value by saving executives countless hours, their already stellar retention rates are going to lock in.
Yeah, they're not going anywhere.
They've built a system that fundamentally thrives on external complexity. The more chaotic the global economy gets, the more tariffs are threatened, the more supply chains break.
The more they need Gartner.
Exactly. The more enterprise leaders are forced to rely on Gartner to make sense of the noise. They are deliberately absorbing margin compression today to ensure they can deliver that critical value faster and more accurately than ever before.
It is a classic setup of short-term pain for massive long-term gain. However, before we wrap up, we want to leave you with one final lingering thought.
Okay, what is it?
A provocative existential question for you to mull over as you continue to do your own research and due diligence on this sector.
I love these.
On the call, management noted that they are not currently seeing their clients substitute their premium advisory services with standard, off-the-shelf generative AI tools.
Right. No ChatGPT replacements yet.
In fact, as we discussed at length, Gartner is successfully utilizing AI within their own proprietary Ask Gartner ecosystem to actually increase user engagement and retention.
They view AI as an enhancer, not a replacement.
Right now, yes. But let's extrapolate this timeline out 5, maybe 10 years into the future.
Okay.
As these large language models become exponentially more sophisticated at actual logical reasoning, and as enterprise IT departments get better and better at securely feeding these models their own proprietary internal corporate data, will there eventually come a tipping point?
It's a scary thought for advisory firms.
It is. Will enterprise executives eventually decide to skip the advisory firm middleman altogether?
Right, just do it in-house.
If an internal, highly trained AI agent can instantly synthesize global market trends, calculate precise supply chain tariff risks, and evaluate software vendor pricing without hallucinating, do you still need to pay Gartner millions of dollars a year for access to their human analysts?
It is the ultimate disrupt or be disrupted scenario. Gartner's entire core thesis rests on the belief that their deeply vetted proprietary data, combined with human-in-the-loop expert validation, will always command a premium over a pure software output.
That's the bet.
They're betting that the stakes are too high for a CFO to trust an unaudited machine, but the technology is evolving at a blistering pace.
It certainly is. And keeping a close eye on how effectively Gartner management continues to navigate that specific existential technological threat is going to be the absolute key to confidently holding this stock for the next decade.
Absolutely.
Thank you for tuning in to this Special Talk Tickers Deep Dive. We hope we provided a clearer lens through which to view these numbers. Keep doing your own rigorous research, keep questioning the consensus, and stay sharp in this volatile market.